Imagine you buy a bond. It's like lending money. You get paid interest regularly. Then, you get your money back later. Duration tells you how long it takes to get your money back, considering both the interest payments and the final repayment. It's not just about the years until the bond matures. Think of it as a weighted average of all the cash flows you'll receive, with earlier cash flows carrying more weight. A bond with a longer duration is more sensitive to interest rate changes. That means its price will fluctuate more when interest rates move up or down. Conversely, a bond with a shorter duration will be less volatile. Duration helps investors manage risk. Knowing a bond's duration helps you anticipate how its price will react to shifts in interest rates. If you expect interest rates to rise, you might prefer bonds with shorter durations. This is because their prices are likely to fall less than those of longer duration bonds. On the other hand, if you expect interest rates to fall, longer duration bonds might be more attractive, as their prices are likely to rise more. Let's say you have two bonds, both with a face value of $1,000 and a 5% coupon rate. Bond A matures in 5 years, while Bond B matures in 10 years. Because Bond B has a longer time until maturity, it will have a longer duration than Bond A. Now imagine interest rates increase by 1%. Bond B, with its longer duration, will experience a larger price decline than Bond A. This illustrates why duration is a key consideration for bond investors, especially in a changing interest rate environment. Duration is a powerful tool for bond investors. By understanding this concept, you can make more informed investment decisions. You can align your bond investments with your interest rate outlook and risk tolerance. Remember, if you expect interest rates to rise, consider bonds with shorter durations to mitigate potential losses. Conversely, if you anticipate falling interest rates, longer duration bonds may offer greater upside potential. However, always remember that investing involves risk, and diversification is key to a well-balanced portfolio.